Let's take a look at how stock futures are moving before we're getting the commentary here from Powell later on this morning. You got futures pointing to some gains here, at least on track to open the day in positive territory. You've got the Dow futures trading just to the upside. You've got the NASDAQ futures also some movement to the upside there. You can see it on the top hand or the top part of your screen there. When you take a look at the S&P 500 futures, that's also looks like we are going to open to the upside here. Now, just putting this in context for you, going back the last 10 years, the S&P has moved on average about 1.3% following Powell's remarks. So that has been a bit more reactionary when you compare it to the moves that we have seen over the past 10 years in the bond market. Right now, we have Treasury prices moving to the upside, yields under just a bit of pressure. When it comes to the behavior that we have seen in the 2- and 10-year yield, following Powell over the last 10 years, that average move has actually been less than 4 basis points. So right now, the options market not really pricing in too much of a reaction when it comes to equities. I was looking at notes here from Deutsche Bank this morning. They're not expecting too much of a move here on the heels of Powell. But again, very important to keep in mind if we do get any sort of surprise here coming up in an hour. Well, 73% of investors are now pricing in a 25 basis point rate cut at its September meeting. That's according to the CME's Fed Watch tool. For more on what to expect, we want to bring in Michael Darda. He's ROTH Capital Partners chief economist and macro strategist. It's great to have you here. So very much, it looks like the market isn't anticipating any sort of big surprise. What about you?
Thanks for having me on. No, I don't think Fed Chair Powell is really going to want to rock the boat in terms of market pricing for this talk today. But my concern is that, the Fed moving 25 basis points at the end of September, that's almost a month away, is that going to be enough to offset the decline in inflation and inflation expectations that we've seen since the spring? And that would be the question I would put to the Fed if I were out at the Jackson Hole conference now. And I'd be very interested in the answer. But I think Powell's approach is going to be slow and steady. Don't rock the boat. He's mentioned the totality of the data, so he's not looking at one data point. And I think that puts the Fed in a posture where there's just not going to be a sense of urgency unless things change drastically in just under a month.
I'm not as good as Fed Chair Powell, so I'm going to look at one data point here, and it is the labor market. And from what you're kind of gathering from the different data points that are coming together, what is that spelling out about the labor market, and how do you suspect that Fed Chair Powell may need to acknowledge what's taking place there?
Yeah, no doubt about it. The unemployment rate has been moving up, not just over 1 month in July, but in a persistent fashion. And now we're up almost a percentage point from the cyclical trough in the spring of 2023. If you go back and look at what that means historically, it's always meant that the economy has fallen into recession. Now, a lot of people are saying, well, it's different this time because we have more growth in the labor force. Any way you slice it, however, it means the economy at a minimum is growing below the growth rate of potential if it's growing at all. And one big problem for the Fed here is that if you're at a turning point, if you're at a cycle peak or the very early innings of recession, GDP can be positive, payrolls can be positive. So this totality of the data approach, I think, can get the Fed into trouble. We see huge revisions in a lot of the data that folks are leaning on to say everything's fine. We're not in recession. Don't worry about the rising unemployment rate. The unemployment rate's actually one of the least revised economic statistics that we have. It's not a leading indicator, but it just might be the most robust coincident to slightly lagging indicator, and hence the most important for the entire U.S. business cycle.
So, Michael, I guess where does that leave then the probability of a recession in your view? Should the Fed then be considering 50 basis points if we are seeing some weakness here, material weakness maybe in some view, of the labor market?
Yeah, that's a great question. So I think the probability of recession is still quite high, even though you wouldn't know that looking at, say, the S&P 500, which has just been on this 2-year tear with a 3-week interruption not long ago. That's almost been completely reversed now. But equity markets can be optimistic right up until the end of a business cycle. So there's not necessarily going to be a bunch of lead time there in terms of what equity investors are doing. The unemployment rate moving up the way it has suggests that we actually could already be in recession. And that is a probability possibility. If not, I think we're dangerously close. And that means that the Fed is way too tight here. The policy rate's too high. I do think they should consider 50. Consider this. Bond market inflation expectations have fallen 60 basis points since the spring of this year. And that means with the policy rate flat, real rates have gone up by 60 basis points. So even a 50 basis point cut in September would only partially reverse that. And again, I would put this question to Fed Chair Powell if we spoke today. Does the committee really want the real policy rate moving up on net at a time when the labor market is losing steam and consumers are under pressure? So, we'll see if we get that answer, but I'm not going to hold my breath.
And it's going to be fun to get back into the conversation about what the terminal rate on the cutting end of this is going to look like. What is your estimation for what we should expect there?
Yeah, great question. So, this is something that's very difficult to model. The Fed, has said essentially that they don't, have a tremendous amount of confidence on where neutral is. They're going to just see how the economy and financial markets perform and respond. I would say, what's a neutral rate for the U.S. economy if we're balanced out and, inflation at target, growth running pretty close to potential, probably somewhere between 1.5% and 3% nominally. And we're up at 5.3 right now. Futures markets don't expect the policy rate to get down into the threes until the spring of 2026. And that means that the Fed could end up behind the curve here. And that's how you lose the soft landing. That's how you lose the business cycle. There seems to be this perception on Wall Street among many traders that if the Fed cuts rates at any time for any reason, that's just bullish. It's up and to the right. The business cycle will be fine. Well, that flies in the face of recent economic history where policy rates came down more than 100 basis points on average before the start of the last 4 recessions. Now, that doesn't mean the Fed shouldn't cut rates. It means that there's no guarantee that the soft landing is going to sustain itself if the Fed is cutting, if they're behind the curve at the same time. And that's really my concern. And the bond market inflation expectations, plus the inverted yield curve, I think reinforce that. Even 50 basis points at this juncture would not completely disinvert the yield curve. Is that really a posture the Fed wants now as inflation gets closer and closer to target and the labor market continues to lose steam?
All right, Michael, it's very helpful for investors to think about here as we head into Powell in just about 45 minutes from now. Michael Darda, always great to have you. ROTH Capital Partners, chief economist and macro strategist. Thanks so much.